Alright, in this video we will be journalizing transactions relating to inventory. So let's get right to the problem here. Derby Company's inventory records show the following at April 30th. So let's take a look at this data table here. And also keep in mind that on April 30th, 8 units were at hand. This part will be critical in one of the later requirements. We'll get to that later. So the first requirement here, let's read it. Journalize the total April purchases in one summary entry using the perpetual system. All purchases were on credit. So when we make a purchase, inventory is increasing. So we know that inventory is an asset account. So when that's increasing, it's debiting inventory. And so how much do we debit inventory to increase it? Well, just simply the total of the purchases. So it's 423 plus 1,800, $2,223. So what do we have to offset that with? What credit offsets that? So now in the requirements, it's stating that all purchases were on credit. So when we made those purchases, our inventory increased. So instead of paying cash for that, we're crediting accounts payable. And it would be for that amount. Same amount, $223. So that's the first requirement. Let's go on to the next requirement here. Let's take a look. The next requirement, we need to journalize the total April sales and cost of goods sold in 2 entries under the perpetual system. The selling price was $400 per unit, and all sales were on credit. Assume that Derby Company uses the FIFO inventory method. So, how much? So the first part here deals with sales. So we know that we need to credit revenue. So how much do we credit? So if you remember up here, the problem states that we have 8 units on hand. So if we have 8 units on hand at the end of the month, and we have this many units purchased or either beginning inventory, so we have 20 units. So we had 5 at the beginning, plus we purchased 15. So we have 20 units to work with. We have 8 on hand at the end of the month. So that means we sold 12 units. And how much do we sell them for? We sold them for $400 per unit. So that is our sales revenue credit here, $4,800. Simply 12 times 400. All right, here. And all sales were on credit, so that's why accounts receivable is $4,800. So we made the sale, we didn't receive cash, but we are increasing accounts receivable for that amount. Let's get to the cost of goods sold side of this. So let's take a look at that journal entry here. So cost of goods sold. Cost of goods sold is an expense account. So an expense account is increasing with a debit. So if you think about it, we sold these 12 units. We incurred a cost, and that cost is being recognized. Cost of goods sold. We'll get to this amount in just a moment. And our inventory, so our inventory decreased when we sold something. We decrease inventory. Inventory is an asset account. An asset account is decreasing with a credit. Let's get to these amounts here. So the key to finding out these amounts is the fact that they are using the FIFO inventory method, which stands for first in, first out. So we sold 12 units. The key here is what units did we sell? So first in, first out method tells us that the first units in are the first ones to leave. So these were the first units to leave. So we sold 12 units. So the first 5, we take those out first. So we incur that cost. The next 3 incur that cost as well. So add those up. So it's 8 units total. So we have 4 units left. So we take those out of this block of 12 of 150. So we have that calculation right here. So again, the first 5 for $140, those went out the door first. The next 3 went out the door at 141, and the next 4, so we have 8 total here. We sold 12. Remember that from before, so we sold 12. So we have 4 left, and we have to take that out of this block of 12 for $150 each. If we were using, and that's how we get to the $1,723. If we were using the last in, first out method, it would mean the last ones in are the first ones to leave. So if we sold 12, it would simply be 12 times 150. That would be the cost of those units that are sold. But in this case, we're using the FIFO, or the first in, first out method. So that's how we get to that calculation. So that's a key part there. So let's move on to the third requirement. So under FIFO, how much gross profit would Derby Company earn on these transactions? All right, so let's get to that first. Let's take a look at the second part in just a minute. So gross profit is simply the sales revenue minus the cost of goods sold, and those amounts are up above, so it's simply subtracting cost of goods sold from sales revenue, which is this amount. So you'll see the 4,800 minus the 1,723, those amounts are up here. The next part of this requirement, what is the FIFO cost of Derby Company's ending inventory? So again, we have 8 units on hand at the end of the month. What is the ending inventory value? So it's, if you remember so FIFO takes the first units in and takes them out first. So remember, when we sold them, we took out these 8 plus 4 out of here, so that leaves us 8 units here at $150 per unit, and that gives us our ending inventory amount of $1,200. So that's the end of the problem. Thanks for watching this video. Have a nice day.